Ladies and gentlemen, a moment ago, I said that Jeff is going to pay penitence and he's going to beg our forgiveness because a week ago on April 9th, the United States said producer prices had reached decade highs in the rate of change year over year. And Jeff, how do who is on your side now saying that this is transitory? Nobody. Inflation is here, Jeff. And how do you explain yourself? What are you going to say now?
I'm going to say I'm very, very, very uncomfortable. Very uncomfortable. First of all, because I'm going to also say that producer prices are indeed at a decade high. That is absolutely true. That is a fact, and it's incontrovertible. And because of how I interpret that decade high, it puts me in the very, very uncomfortable position of being in agreement with one Jerome Powell, chairman of the Federal Reserve.
With the article that we're discussing, it was posted at Alhambra Investments blog on April 9th, and the title, if dear audience you want to read along, it's Scorching, Blistering, Highest in a Decade. Powell's the voice of reason here, and we don't get immediately to the most recent PPI explosion. Instead, we go back a few years, and we go back to the age of Bernanke, 2011 and 2012, when something similar happened, and incredibly, something similar was heard from Bernanke that we're going to be hearing from Jay Powell, as we'll discuss later. Take us back in time.
Well, so already your skepticism should be triggered here. Yes, decade high sounds really, really, really impressive, and maybe in some ways it is, but just doing some simple math, it's 2021, subtract 10 years, that gets us to 2011, 2012, somewhere in that period, which that didn't turn out quite the way it was supposed to have either, right? So, going back to the 2010, 2011, 2012 period, we're already on alert that, okay, we've seen this before and we kind of know how it turned out back then. And so maybe the highest in a decade doesn't necessarily mean what it sounds like it's supposed to mean.
And excuse me, while I clear my throat from shock, and I'm showing a graph right now, and we're looking at PPI, we're looking at the index value, and then the rate of change year over year, and you've got the data all the way out through 2011, and you've got a very nice line that serves as our trend. That's kind of our goal, is to get back to recovery. And we see 2010, 2011, strong surges. But guess what? Bernanke, this is the part that I was a little bit shocked about. In September, he says this, September of 2011, I believe it was.
Yes.
However, inflation is expected to moderate in the coming quarters as these transitory influences wane. In particular, the prices of oil and many other commodities have either leveled off or have come down from their highs. He's watching the show, Jeff, from the future.
No, it's simple. A lot of it's just simple mathematics. First of all, when you have a severe deflationary shock, coming out of it, the percentages are going to look amazing, because if you go way down, coming way back up, or even part way back up, just by simple arithmetic, the numbers look huge. And what he was saying is that, look, for one thing, inflation prices have rebounded from extreme lows set in 2009 and then revisited to some extent in 2010. So we have in 2010 and then again in 2011, these enormous base effects, which are making particularly commodity rate related indices look very, very strong in a way that they really weren't. So base effects was one thing. Yes, prices are coming back, but does that necessarily mean sustained inflation? And that's really what we're talking about, sustained inflation. What Bernanke was saying is, look, the combination of base effects plus commodity prices rebounding, and the commodity prices rebounding contributing to those base effects was not a sufficient condition for saying, look, this is going to turn out to be an inflationary that he was looking for, or anything more than that.
And you say, but they did make an assumption. Yes, they got that part right. The part where they went wrong was in how they expected the economy to actually recover. And now we're pulled up the same graph essentially, but now we filled in all the way through 2012, and we see how that PPI year over year falls to a very low level, and then the index levels out, and it never gets back to that trend that would signal some sort of recovery or back to what we had experienced before, or even if it was overwrought, inflation, which is what they were after.
Yeah, what Bernanke was saying, and he was actually right. And where he went wrong was in expecting that this was going to happen because of QE and monetary policy. But what he said was, look, commodity prices rebounding, base effect, these kinds of things are good signs. Those are things we want to see because it tells us that we're no longer in the contraction phase, right? We're coming out of it. But it may be a necessary condition, but it's not sufficient by itself to lead us into recovery. And what he meant was, what he was looking for in terms of actual inflation, let's again be specific. When we're talking about inflation here, what we mean is not just the price of one thing or another going higher or food prices going up. It's the sustained advance in pretty much everything. Now, what the Federal Reserve is targeting is a low-level sustained advance in the price of everything. But that inflation is that. It's not something, it's not a short-term spike. It's not just one category or another. It's a sustained, broad-based increase in consumer prices. And he believed that that was going to happen, just not as soon as 2011 or 2012, because by then he was already realizing that the economic recovery was a little bit too shaky. It wasn't going as well as planned. I mean, I think it was Mohammed El-Erian from PIMCO had already called it the new normal by then, which was the idea that something wasn't right here. And what Bernanke was saying is, so because the recovery isn't coming along the way we thought, we're going to have to give it more time. So these base effects recede, the commodity prices start to level off, you're going to see inflation indices come down too. And he was exactly right about that part.
You know, just a very quick pet peeve of mine. New Normal by Mohammed El-Erian, Secular Stagnation by
Larry Summers.
Why can't they say depression? I'll tell you why they can't say depression. Because they were put in charge of preventing such a thing from ever occurring. Okay, it's not a Great Depression. Fine, good job. It's still a depression. That's why they don't use that word. If they did, it would say, who's at fault? The economists. Okay, moving on. That was just, it always bothers me when I hear these euphemisms. So inflation is, we don't want just producer prices increasing or just prices. We want inflation. We say it's good, which is hard to believe because it means employment has been brought to near or full capacity, right? And therefore wages are up and businesses are paying people more. And therefore, inflation is rising.
Bernanke was saying in 2011, transitory factors are what we're seeing. We want to see non-transitory factors contribute to price increases, which is just what you said. It's an economy that's reaching full employment, an economy that's actually legitimately recovering to the point where businesses feel they have to raise prices because they're competing for workers. There's a shortage of work, all the good things that we associate with economic recovery. And so in that sense, inflation isn't a bad thing. Again, this is not my opinion. I'm just telling you what central bankers and economists believe. They say that when you see a little bit of inflation in that situation, that's a good thing. It's a good sign. It's a sign that things have returned to normal and have gotten to the point where we've reached our potential, which is the best anyone can ever ask of any economy anywhere and any time. And so the inflation sign, the non-transitory inflation that the Bernanke would continue to talk about for the rest of his tenure, as well as Janet Yellen and Jay Powell, because it never showed up. They kept looking for this non-transitory inflation because that was the signal to themselves and the rest of the world that their quantitative easing policies and zero interest rates had actually boosted economic growth to the point that we had returned to the pre-crisis potential. And it just never happened.
And that's where Jay Powell steps in the tradition of Ben Bernanke saying, yes, okay, PPI, base effects, huge increase, but that's slack. That employment slack, we're nowhere near full capacity. Therefore, these will just be transitory. I'm going to pull up a graph of the same sort of graph we've been looking at, but moved ahead to 2021. And we see the exact same thing that Bernanke saw in 2010, 2011.
Yeah, and it's interesting, Emil, right, that Powell used almost the exact same phrasing as Bernanke did. I mean, in the quote that I think I put in the article, he said transitory. I believe he said the inflation the expected inflation this year is transitory. And of course, he's gotten, like Bernanke did in 2011, he's gotten all sorts of grief over it because inflation and consumer prices is a very emotional topic for many people. And again, far be it from me to defend the guy, but I think in this case, he's like Bernanke was in 2011, they've got it exactly right. These are transitory inflationary factors that aren't really inflationary factors. They're simply mathematics of consumer prices rebounding off of last year's extremely low levels. That's really what we're seeing. All we're seeing is the initial rebound. That's not the same thing as recovery. It may be the first step toward recovery, but it's not a sufficient condition by itself to be it. And what Powell is saying is that, look, the economy is in really bad shape. And the reason he's saying the economy is in really bad shape, because unlike Bernanke, Powell has something that he can point to and say, oh, I can blame COVID. This isn't my fault. I've got somebody I can be honest. I can say things that more honestly than Ben Bernanke ever could, because I can say, hey, there's this pandemic thing going on that's preventing economic recovery, and I can be more open with it. Whereas Bernanke had to be very careful in 2010 and 2011, because the thing that was hindering recovery back then was that global financial crisis thingy that was supposed to have been solved by this heroic Federal Reserve action. But it's interesting that here we have Jay Powell being the voice of reason in the exact same way, and he's being criticized in the exact same way as Bernanke in 2010 and 2011, when we saw the initial rebound in not just commodities and producer prices, but also in consumer prices too.
That is a very perceptive analysis, Jeff, and we should end on it. That would be a good way to end the show. It's because of COVID that Powell can get away with this. But I'm going to pull up a few graphs now. We don't have a lot of time, and you did go over this in your Macro Voices appearance yesterday on the 15th of April with Eric Downson. It was a great show. I'm going to pull up a few graphs that show, even if we don't look at COVID, that the monetary system is telling us there's a problem. And the first one I'm going to pull up is the US yield curve. So we've done this before, but just as a reminder for people who maybe are joining us, what is the monetary system telling you about where we are, and that this inflation that we're seeing in PPI will be transitory?
Well, Powell's version is that, look, pandemic changed everything. The economy was operating really, really well. It was booming before COVID, and COVID wrecked everything. And that's just not the case. What the market is saying is that we're still in the same lack of growth, lack of inflation, disinflationary rut that we'd been in since Bernanke, since going back to August of 2007. And so the market is saying, we agree with Powell, but for very different reasons. Yes, the inflationary aspects of what we're seeing now, the rising prices, commodities rebounding off their low, even these decade-high PPIs are unconvincing. They're not very compelling, because like what Bernanke said a decade ago, that these are just transitory factors that will quickly dissipate, and that the non-transitory inflationary factors that we need to see to transition into recovery, to tell us that we're transitioning to recovery, those remain conspicuously absent, which is what Jay Powell's position is, but for different reasons. So Powell and the market are actually agreeing, if not for the same exact underlying premise.
And I've got US nominal Treasury yield. This is the 10-year note, and you're comparing the current reflation to reflation 1A and 1B, and the current reflation is up, as it should be, but it's sort of meh, not really. The next graph.
Yeah, which you would expect, right? If we were seeing this difference, if something different had come along, we would expect to see the yield curve, Eurodollar futures curve, whatever it might be, would be behaving very differently than it has during these reflationary episodes in the past, which are very similar in how they work out. And we're not seeing that. In fact, as you point out all the time, Emil, this reflation number 4 is the weakest. It's by far the weakest of all the entire bunch. We're not even close to what Bernanke was seeing in 2010 and 2011. We're way, way below it in every single dimension.
And those dimensions included the nominal yield curve, long-term inflation expectations as determined by markets. What else here? The break-evens, which we're discussing on previous shows, the household survey, And what else? What other graph are we here?
Yeah, this is
yields.
I think the real yields are really one of the biggest signals that this the real yields are the tips nominal, which tells you what the market is thinking about actual legitimate economic growth moving ahead, and we're not really that far off of record lows. And that's the market saying that yes, we see commodity prices rebound, we see you PPI, we see you at a decade high, but that's just nothing more than, again, what Bernanke was talking about and Powell is talking about recently, transitory effects that are not going to have, that do not signal anything different in an underlying economic condition that is absolutely atrocious.
In part 3, we are going to discuss a very specific bond. Normally we talk about bond yields and we talk about the whole curve. But ladies and gentlemen, I want you to hold on to your seats because we're going to be discussing bond 91282CBN0, and you're not going to want to miss it.
All right.
But first, this from Eurodollar Enterprises. Friends, are you worried your monetary policies are causing lurid levels of inequality? Are you concerned civil war, its hour come round at last, slouches toward K Street? Do you worry how your supple neck will fare when the blood-dimmed tide is loose? Then the new Eurodollar Enterprises second skin neck brace is for you. Yes, strut through the wasteland knowing that marauding lynch mobs of war boys pose no danger. The carbon-fibre nanoweave is comfortable, flexible, and the ultimate luxury in an April dystopia you hastened. Barter aquacola for guzzoline at Thunderdome with no concern of the guillotine. Is that the road warrior with a chainsaw? Then save your skin with your second skin neck brace. New from Eurodollar Enterprises.